let's also go across to the Reserve Bank of India, which is conducting a conference call right now.
But far from the entire explanation, the sound econometric studies that I've seen that look at this, say, anywhere from 10 to 20% of the increase. And of course, it's hard to say over what period and what portion of the overall increase of the last 4 or 5 years is due to this. One of the concerns more recently has been that these wages are indexed to inflation. So they tend to move up with inflation and create effective indexation of rural wages. That said, I think there are other factors which are also responsible for rural wage increases, including the rise in minimum support prices, which has increased the price of food and therefore increased the subsistence wage. But also, I would say the increasing construction and the rural prosperity generated by land sales has also been partly responsible. Construction, because that's a place where unskilled labor can be used. So all these factors play a part. Hard to point to just one factor, and therefore I don't think it would be fair to say that's the central factor.
The next question is from Kumar, Kotak Securities. Food prices are dictated by the government through MSP, food subsidy, etc., and syndicate of traders. Decides prices of fruits and vegetables as per one recent newspaper article, which accounts for nearly 50% of CPI. In fact, average CPI has been over 8% since 1970. In such a scenario, how can RBI reduce inflation by raising rates?
This is a much asked question, and I think first it's not just food prices which are going up. It's the price of services, for example, which have been going up steadily over the last few years, including services like education, healthcare, and housing. So let's not just say it's food prices and nothing else is moving. There are lots of other things that are moving. So at the very least, if you can't stop food prices increasing, you can try and attenuate the second round effects, the spillover into more general inflation, which certainly is in the realm of monetary policy. That's number one. Number two is that clearly you have to push on the government to both increase the supply side but also reduce the incentive or the pressures on food prices. For example, over the last year, the government has become more moderate in its acceptance of agricultural support price increases. They have been quite moderate over the last year. Going forward, hopefully that moderation will continue, and that will take off some of the upward pressure on food prices. Also, if you look at some of the food commodities that have increased most in prices recently, you also see the supply response starting to kick in. So the idea that prices will go up without a supply response emerging. Remember, there is a lot of private activity in agriculture, and that is responding to higher prices. So I think prices are doing what they're supposed to do, and to give up the fight on inflation, saying food is beyond our control, I think is overstating or understating the powers of the central bank.
The next question is from Sanjeev Mota, asking Investment Management. In December, you had said, given the weak state of the economy, the inadvisability of overly reactive policy action, as well as the long lags with which monetary policy works, there is merit in waiting for more data to reduce uncertainty. Today, that is yesterday, you said the slowdown in the economy is getting increasingly worrisome. Also, the inflation data, if at all, has improved. Despite this, you still raised rates and also mentioned that the so-called trade-off between inflation and growth is a false trade-off in the long run. Are you thus clearly saying now that the inflation is a key variable that you are going to focus on?
Now, note the word long run. I think in the short run, clearly, there are some trade-offs. In fact, we try and exploit those trade-offs. But the broader point that was trying to be made in December, and I think was that in an environment where the economy is weak, we should wait and look to see look for data which clarifies the noise, so to speak, before we act. One piece of data was headline inflation. Is headline inflation as rampant as we saw in December? And our thought was no, because we already had data coming in suggesting that that vegetable inflation was coming down, and in fact our stance there was vindicated. However, we also said we are looking at these second round effects, we are looking at the feed through into services and so on, and we want to see whether the weak economy, the disinflation that has happened, that will feed through into lower core inflation, and that was the second aspect of our guidance which was given in December. And unfortunately, there's a lot of debate I can see on the net about how you calculate core inflation, but the fact is it didn't come down in a significant way. So in that sense, even though we had given another 1.5 months to see some effects, it had not materialized as strongly as we would have liked. Of course, there's been some reduction, but we would have perhaps liked to see a stronger reduction in core. So, given that, we thought that a certain increase in rates would be appropriate. Of course, we want to wait and see how these things play out, and that is why yesterday we said we're going to wait for more data before we decide on further moves.
The next question is from Sonal Verma of Nomura Securities. Keeping aside the owl analogy, hike with a dovish guidance or pause with a hawkish guidance, as in December, is confusing. The takeaway for many yesterday was that this could perhaps be the end of the rate hiking cycle. Most banks are unlikely to change their lending or deposit rates, so how will transmission happen? Doesn't this run counter to the objective of getting inflation and inflation expectations down?
Well, I think the point that I made yesterday in the press conference, and that I'll make again, is yes, that at this point deposit rates are being attuned to the high levels of inflation. My hope is as the disinflationary process plays out, the policy rate will become once more central to the rate setting process, at which point it will start gaining traction. We have to wait and see if that plays out. Again, this is part of our assumption. And so even though now we're still somewhat infra-marginal, my hope is that as the disinflationary process plays out, we will become more marginal, and that's really what we're waiting for. Now, on the hawk with dove and dove with hawk and all that, I mean, the whole point is that we are trying to craft a path in an environment where the economy is relatively weak, and we have to be careful that people, I'm not talking about analysts,